What if I told you that the key to building a really powerful long-term investment portfolio isn't buried in some complex algorithm or the latest tech craze, but it's actually sitting right there in your kitchen? Yeah, hiding in plain sight. It's a fascinating idea, so let's dig in. Welcome to another deep dive on investment basics. In this analysis, we're going to break down one of the most stable sectors in the entire market, all through the lens of research from Mr. Majid Butt. We're going to peel back the labels on those brands you see every single day and find out what really makes them tick. So here's what we're going to cover. We'll start with what this sector even is, then we'll get into the 4 core ways these huge brands manage to grow. We'll look at their biggest strengths and some hidden risks you've got to know about. And you are definitely going to want to stick around to the end because we have a detailed 6-point checklist for investors that you can use right away. Here's our roadmap. We'll start with the empire in your cabinet, then look at the 4 paths to growth. Figure out how they build an economic moat, switch on the investor's risk radar, and wrap it all up with that 6-point success checklist. Let's get to it. First up, the empire in your cabinet. Let's really understand the business of these everyday brands you know so well. So, what exactly is the consumer goods sector? Well, it's actually super simple because you're a customer every single day. We're talking about companies that make and sell all the stuff you use constantly: food, drinks, personal care products like shampoo, even tobacco. You know, brands like Tide and Oreos are the absolute poster children for this entire industry. Now, from an investor's point of view, this is where it gets really interesting. These companies are known as defensive havens. Just think about it for a second. When the economy gets a little rocky, you might hold off on buying a new car, right? But are you going to stop buying toothpaste or laundry detergent? No way. People buy this stuff no matter what, which makes these companies incredibly resilient when times get tough. But, and this is a big but, that stability comes with a trade-off. This is not some high-flying tech sector. As you can see here, growth for consumer goods is usually slow and steady. It pretty much just mirrors the overall growth of the economy. And in some really mature markets, like beer here in the US, growth is basically flat. So the takeaway is crucial. You're not investing for explosive returns, you're investing for consistency. All right, so that leads to a huge question. If the market is growing so slowly, how on earth do these absolute giants get any bigger? This is the central challenge they face every single day. Well, they basically have a 4-part playbook. 1, they can try to steal customers from their rivals by launching new products. 2, they can just buy other companies. 3, they can squeeze more profit out of what they already sell by cutting costs. Or 4, they can look for new customers in other countries. Let's look at each one. First up, new products. This sounds exciting, but man, it is incredibly expensive and super risky. Just look at this number. PepsiCo spent almost $730 million on innovation in just a couple of years. And the brutal truth is, most of these new products fail. We're talking thousands of launches a year, and maybe 100 or so will actually succeed. It's a tough game. Okay. Path number 2 is buying other companies, and this is a total gamble. It can go really right or really wrong. For a success story, look at PepsiCo buying Quaker Oats. It was a perfect match. They were both in food and drinks, sold to the same stores, total synergy. But then you have a failure, like when Gillette bought Duracell. The businesses were just too different. Gillette's whole razor and blades model just didn't work for batteries, and it ended up being a huge mess. Strategy number 3, cut costs. Since sales growth is hard to come by, a lot of these companies focus on becoming more profitable, and they can be really good at it. Take Colgate-Palmolive. They managed to boost their operating margins from 14% all the way up to 20% just by getting more efficient. But here's the danger. If you cut costs too much, you might stop investing in your brands, and that can really hurt you down the road. And the 4th and final path is to go global. When your home market is tapped out, you've got to look overseas. And for these big guys, this is absolutely essential. I mean, look at this. A whopping 77% of Coca-Cola's profits come from outside the US. For Avon, it's 65%. For these giants, international expansion is everything. So these companies are stable, they have clear ways to grow. But what stops a new, scrappy competitor from coming in and stealing their lunch? Well, that brings us to one of the most important concepts in investing, the economic moat. If you've ever listened to Warren Buffett, you've heard this term. An economic moat is just a fancy way of saying a company has a durable advantage that protects it from competitors. It's like a real moat around a castle. It keeps the bad guys out and protects the treasure inside, which, in this case, is long-term profits. In the consumer goods world, these moats usually come from three main sources. First, being so massive you have huge cost advantages, that's economies of scale. Second, having brands that people know and trust. And third, controlling the way products get to the store shelves, that's dominant distribution. Let me tell you a quick story about that third one, distribution, to show you just how powerful and frankly, how brutal it can be. For years, 7-Up didn't have its own bottlers everywhere, so it paid some of Pepsi's bottlers to distribute its soda. Then, Pepsi decided to launch its own lemon lime drink, Sierra Mist. You can guess what happened next. Pepsi basically told its bottlers, "You're with us or against us. Drop 7-Up." And just like that, 7-Up was kicked off the shelf in huge parts of the country. Okay, we've talked a lot about the strengths, but smart investing is all about seeing both sides of the coin. So let's fire up the investor's risk radar and talk about the things that can go wrong in this seemingly safe space. You really need to keep four big risks in mind. First, the Walmart effect. Giant retailers have so much power they can squeeze the profits of the companies that make the products. Second, for tobacco companies especially, there's massive litigation risk. Third, since so much of their business is overseas, a strong dollar can really hurt their reported earnings. And finally, because everyone knows these companies are safe, their stocks can get really expensive. And that brings us to the payoff. We've laid all the groundwork, and now it's time to put it all together. This is the 6-point success checklist, your practical, actionable guide to analyzing any company in this sector. Okay, number 1. Find companies that enjoy the cost advantages of manufacturing on a larger scale than most other competitors. This is all about finding the industry giant. A company like Anheuser-Busch, with its massive breweries, can make beer cheaper than anyone else. That cost advantage is a huge source of profit and a powerful weapon against smaller rivals. Checklist point 2. Look for the firms that consistently launch successful new products. All the better if the firm is first to market with these innovations. Now, we're not just talking about a new flavor of chips. We're looking for real game changers, like when P&G came out with the Dryel home dry cleaning system. You want to find companies that have a proven track record of creating things people didn't even know they needed. Number 3 is huge. Check to see if the company is supporting its brands with consistent advertising. A brand is like a garden. You have to keep tending to it. When you see a company like Anheuser-Busch spending big on Super Bowl ads, that's a good sign. Be really careful if you see a company cutting its ad budget or constantly putting its products on sale. That can be a sign they're sacrificing long-term brand health for short-term profits. Point 4. Examine how well the firm is handling operating costs. Now, a smart restructuring to become more efficient? That's great. But if a company is announcing a new cost-cutting plan every 2 years just to meet Wall Street's expectations, that is a major red flag. It probably means the core business is struggling and they're out of good ideas. Number 5. Because these mature firms generate so much free cash flow, it's important to make sure management is using it wisely. These companies are absolute cash machines. After they've paid all their bills, they have tons of cash left over. You want to see management returning that cash to shareholders, either through paying dividends or by buying back stock. It shows they're working for you. And finally, number 6, and this might be the most important rule in all of investing. Look for buying opportunities when shares trade with a 20% to 30% margin of safety. What does that mean? It means even a fantastic company is a bad investment if you pay too much for it. You have to wait for a good price, one that gives you a buffer in case you're wrong. That's how you protect yourself and set yourself up for great returns. So there you have it, the whole checklist. You're looking for scale, innovation, brand support, smart cost control, shareholder-friendly cash use, and always, always buying at a great price. This framework is your key to sorting the good from the great. We've covered a ton of ground here. So now that you know what to look for, the next time you open that fridge or walk down the aisle at the grocery store, look at those familiar brands with a new set of eyes and ask yourself, which of these companies are building the strongest castles? The answer might just be your next great investment.